Brad Williams, Frugal Finance. What are stock splits? Take, for example, Apple. Apple Computer. Stock's trading at $400 one day, and the next day it's trading at $100. You just thought you took a $300 loss until you realize now you have 4 times more shares of Apple than you did the previous day. Nothing's changed other than the number of shares and what the stock's trading at. That's all a stock split is. That was a hypothetical. I think when Apple, their last split, I think it was a 10-for-1, maybe 20-for-1, brought the stock down to $50 a share, but now you have 15 times more shares. Not a big deal, but it is a signaling issue. What is that signaling? It's just something that momentum investors take as a sign that perhaps the stock will continue going higher because now the price is lower. It makes no sense. A stock split, there are many ways you can slice a pie and reasons why you might want to serve larger or smaller pieces, but if you go too big, the size of a piece can become overwhelming. Sometimes the same could be said of stocks. When a stock price gets high, sometimes a public company will want to lower the price and can do that with a stock split. A stock split is a decision by a company board to increase the number of outstanding shares in the company by issuing new shares to existing shareholders in a set proportion. Stock splits come in multiple forms. The most common are 2-for-1, 3-for-1, 3-for-2, 3-for-1. Keep in mind, this is probably dated. We're seeing 10-to-1 and 20-to-1, looking at stocks that were at $1,000 one day and then $50 the next. For example, let's say you own 10 shares of stock trading at 100 in a 2-for-1 split. The stock would give you 2 shares with a market adjusted worth of $50 for every 1 share you own, leaving you with 20 shares. Or in a 3-for-2 split, the company would give you 3 shares with a market adjusted worth of about $66.67 in exchange for 2 existing 100 shares, leaving you with 15 shares. Well, you now have more shares than you started with. The total value of the shares is the same as it was before the split, $1,000. And while the company's shares outstanding increases with the split, its market capitalization, the total value of the company derived from multiplying the number of shares by the stock price, remains the same. One reason companies split their shares is that a psychological barrier might occur with trading higher priced shares. A very high stock price can intimidate investors who fear there's little room for growth or what is known as price appreciation. Meanwhile, a company with a lower stock price might engage in the opposite behavior, a reverse stock split, to increase its per share price. Companies that are having financial difficulty or can't meet FINRA, SEC, NASDAQ requirements might need to reverse split, artificially drive up the price of that stock. A reverse stock split tends to occur with small companies that believe their stock price is too low to attract investors. Companies might also do reverse splits to maintain their listing on a stock market that has a minimum per share price or to appeal to certain institutional investors who might not buy stock priced below a certain amount. More often than not, a reverse split involves a company that trades in over-the-counter. Reverse stock splits are less common among seasoned companies that trade on one or major U.S. stock exchanges. Keep that in mind. Risk, risk, risk. If a reverse split is announced and actually occurs, proceed with caution. Reverse splits tend to go hand in hand with low-priced, high-risk stocks. This is especially true with reverse splits that result in a post-split share price that is many times the price of the stock's current price. Here's how a reverse split works. Say a company announces a 200-for-1 reverse split. Once approved, investors will receive 1 share for every 200 shares they own. So if you own 5,000 shares of stock at a price of 10 cents per share, worth a total of 500 before the reverse split, you would own 25 shares at a price of 20 each after the reverse split, maintaining that total value of 500. The amount of money you have invested doesn't change, just the number of shares you own. The role of the regulator? As the SEC explains, state corporate laws and a company's article of incorporation and bylaws generally govern the company's ability to declare a reverse split and whether shareholder approval is required. If a company is required to file reports with the SEC, It may notify its shareholders of a reverse split in a number of ways, including Form 8K, 10K, 10Q. FINRA does not approve reverse splits, but it does process reverse stock splits as part of its function related to company corporate actions. In the OTC market, OTC companies can submit notice to FINRA 10 days prior to the record effective date of the corporate action. Once a corporate action submission is successfully processed, which may take longer than 10 days, it will be posted to the OTC daily lists and so on and so forth. Remember that stock split or a reverse stock split does nothing to change the value of a company. How a stock performs in the long run depends on multiple factors, not on how its shares are split. Comment. If you don't understand what stock splits are, reverse splits, post your concerns. Any other questions related to corporate actions? Let me know. Brad Williams, Frugal Finance. Thanks for watching. Hope that helped. See you soon.